At the time, there were no tables that allowed you to assess what the risk in that market was. And if you looked at the people on the other side of the transaction, I bet their returns were actually very good. They were making good risk-adjusted returns for bearing the intrinsic uncertainty associated with the fact that people didn't know how long I would have lived in the 17th century. There's still a market for such products today, and I bet the returns have gotten much tighter because the risks are well understood. Mortality tables are around. Okay. In approximately 2000, there was a market for middle market loans, so that the vineyard up the street would want to expand its production, would need to come up with $10 million or $5 million to go out and buy another vineyard. And they paid a return on it, and the return was probably pretty high. That's my sense. And as liquidity comes up in this market, and as the transparency in the market improves, my hypothesis or my conjecture is that the spreads will actually go down. So, from where I sit, I think of the world as being divided up into information that you can use to evaluate risk. A banker's fundamental role is to evaluate credit risk. And at the very top end of the spectrum, there are things like agency ratings and public firm EDFs that Steve will tell you about next that allow you to get a sense of the default risk for the very biggest firms that are actively used throughout the market. Then at the very bottom end of the spectrum is consumer credit and very small business firms, which will use things like behavioral information. Have I maxed out all my credit cards to predict default risk or truant or latent risk? Whereas in the middle is everything else. So the vineyard up the street would probably be there. It's a company that's not big enough to access the equity market, not big enough to get an agency rating to go out and get a debt, but is too big to be assessed according to whether or not they've maxed out all their credit cards. And for that, what has traditionally happened is bankers have relied on financial statement information and fundamental analysis to assess the risk of the firm and have gone out and lend them money accordingly. Now, in the past 20 years, the concept of probability of default has had a big impact on how banking was done. In 1987, nobody in banking knew what a PD was, or an LGD was, or an EAD. It was in college. And what has happened is three things that I don't think are unrelated, but have happened separately, is that one, we've learned how to measure the probability of default of giving credits. Two, the probability of default is playing a key role in regulatory capital, and the regulator saying how much capital you need to hold in your portfolio. And then three, if you want to figure out how to structure a collateralized loan obligation, you need some understanding of what the probability of default is. This is traditional middle market banking set up to look like what's called a CLO or a CDO. So there's a reference portfolio, the asset side of the balance sheet. And that's going to be loans to small, middle, medium-sized enterprises. And then there's the liabilities. The senior tranche would typically be the depositors, and the equity tranche would be the bank shareholders, the people that own the bank. And middle market banking could be characterized as a rule that I've heard called the rule of 3-3-3. I've also heard it called the rule of 3-6-3, which is borrow at 3, lend at 6, and get to the golf course by 3. It's an old joke. And key to getting that system to work is, one, you have to lever up your portfolio. For every dollar of your own money you put into it, you need $9 of somebody else's money. And if there's no losses, then you're making 30% return on your own money. If losses are 3%, you're breaking even. So you had to manage your losses. And typically, losses might be around 1%. Bankers knew that. In a bad year, it would be 2.5%. Good year, it'd be like 0.5%. Another component to getting that system to work is that you need to manage the so-called run-on-the-bank risk. Okay? In banking, there are many systems in place to prevent a run on the bank. And the reason why a run on the bank could happen is that these people, the depositors, become fearful of the value of these loans. So they become fearful that they're not going to get their money back, so they all run to the bank. And the reason why they're running is the person who gets there first recovers fully, the person who gets there last recovers nothing. Now I bring up this example, when in the United States was the last run on a bank? In my opinion, it's not an FDIC insured bank, but in my opinion, if you look at what happened at New Century Financial, that actually has a lot of the makings of a run on the bank. What they were doing is that they were originating mortgages called subprime mortgages, and then they were supposed to be securitizing them off the balance sheet so that they were acting as a middleman. But in fact, they were building up debt on their balance sheet, which was being lent to them by large financial institutions through what I would call margin account, but the technical term for it is a warehousing credit facility. And then when the subprime mortgage market tanked, the banks became fearful that this was smaller than this, that this was smaller than their share, and they called the margin account. And one triggered the other, and the whole firm got shut down. Okay? I'm bringing that up because that's a type of risk when you're running this type of business you need to think about. Now, the growth of the collateralized loan market may be transforming so-called middle market banking. This is from a Moody's report, a Moody's Investor Service. And this is 1990, this is 2006, I'm sorry, 1999. So it's grown from a $2 billion business to a $15 billion business, which to me is a lot. It's not as big as the syndicated loan market. It's about 1/300th of the total debt outstanding, but it's rapidly growing. And then it's happening in many parts of the world. So this is the growth of the number of deals going on, and particularly in Spain and in Germany it's growing rapidly. And it's also active in Japan. Okay? And there's certain regulatory reasons as to why it will work in one country but not in another. Now, if you look at the way these deals are set up from the perspective of a middle market bank, there's an equity tranche, which for this specific deal is called the preferred shares. And then there's everything that sits above it in the liability structure. They're called senior tranches and mezzanine tranches. In this particular deal, the most senior tranche is 66% of the outstanding exposures, and it gets a spread of 22 basis points on LIBOR. Okay. So it's a very tight spread. So you've taken what was a very illiquid market and structured it in such a way that a portion of the debt becomes AAA. So now insurance companies can buy it. So the spreads are very tight. And when you look at the deal as a whole, there's different tranches, but the average cost of capital is about 45 basis points, 46. So effectively, the equity tranche is earning a 4.5% return is a typical return that you see in this market, and they're getting 45 basis points. So that they're effectively replicated the structure of a middle market bank. And they've levered it up. And the sense is that if the default risk, if the losses in these deals are low, the equity owners get a handsome return. So key to doing this is there's different ways to structure these things. One of the things that will happen is, so suppose you make 50 $10 million loans for a $500 million deal. That would be a typical deal. You don't make 50 $10 million loans on the same day and then sell them off on the same day. There's a timing issue. And there's different ways to manage the timing issue. One is with a warehouse credit facility. Another is what a group in Switzerland does, where they actually have people sign up for the deal every 6 months, and then they float the money and then write the check. So they actually have the participants sign up for the loan, then they sell off the structure, and then they write the check. So there's never any debt on their balance sheet associated with these deals. But if but the other thing about this is when you're trading in this market, what you want to avoid is a lemons problem. Okay, so you have these specialty finance firms who are going out and lending money, and what you want to avoid is getting a debt where everybody turns out to be or buying a tranche of a deal where everybody turns out to be a bad credit. And in order to do that, you need a model, which is where risk calculation comes in. try to hold still. Go ahead. So the way this market emerged in the early part of 2000 was that the rating agency looked to risk calc as a way to rate these 50 deals rather than to rate them all at once according to the traditional methodology. And it also put in a haircut that was fairly substantial in the sense that they said if the model said it was investment grade, they automatically notched it down to a B3. And they did this for a variety of reasons, one of which is this is a new market, we want to be conservative. Another reason is that fundamental to the rating process is that very small firms are fundamentally risky. Rightly or wrongly, that is fundamental to the rating process. And then a third reason is that they could. The state of the market is such that these small enterprises that appear to have low risk mathematically actually trade at pretty high spreads. So you can treat them as though they have high risk. So, but the performance to date on these deals has been very strong in both the US and in Europe and in Germany. And the comeback to that is they haven't been stressed through a really strong adverse economic environment. The market started growing during the last recession. So how do you actually rate the deals? And that's where I'm going to now go into what this modeling approach that we use that we call risk calc is and how it works. And this is one application. So risk calc is a network that began in 2000. It has 22 different country-specific models, all of which are based on localized accounting practices, so that there's data from the local country that's used to build the model, predict default. It's used by banks throughout the world as well as other financial institutions. And it's used for many purposes. One of the two key ones would be Basel compliance. It's used in regulatory compliance, and another one would be securitization. But it's also used to set transfer pricing in an interesting way that I can tell you about, and in portfolio management and so forth. This is our map. We have lots of coverage throughout the world. The red are where we have a model. The credit research database was an effort that began in 1997. And at that time, going into a bank and getting financial statement information from the banks that you could link with credit performance was revolutionary, if you will. Nobody was doing it, and nobody understood the value of it. So in 2000, most banks had a very hard time saying for this type of loan what the actual default rate was. And what we did is we created a consortium of banks that all agreed to give us their data, and we worked with them to collect their data, and that allowed you to have the foundation to build a credible model from. These are some of our clients, and this is our database is huge. Today we have 170,000 odd defaults. So you have many, many defaults in this world to build a database versus the public universe or the large corporate universe or the rated universe where you have much fewer. So it gives you more flexibility to learn things from. Okay. So this is kind of some of the difference between an academic model and a model that people will use in the marketplace, perhaps, which is that you seek to keep it simple, but at the same time be very predictive. Okay. But the model, you have to be able to explain how the model works. It has to be intuitive and it has to be reasonable. So if you get a counterintuitive ratio, you drop it. For better or for worse, that's typically the way it's done. But at the same time, we want it to be highly predictive. We want it to be as predictive of defaults as possible. And risk calc is designed to balance this assessment and to extract assessment of risk from all the financial statement information. Now also, key to that, as part of the intent of the model, is that you don't actually read the footnotes, not because we don't believe there's value in reading the footnotes, but because the intent of the model is to have 15 or 16 line items from financial statements that you can put into the model and get an assessment of risk from. Okay. And then people are welcome to read the footnotes and come up with an assessment of risk that differs because there's off-balance sheet items. That's the current state of the model. And it makes adjustments for industry differences, and then it also has an assessment of the current stage of the credit cycle. So one of the challenges of building a financial statement default risk model is, well, what would you use to predict default? Well, you would use financial ratios. how many financial ratios are there and which are the best ones. I'm sure we could easily come up with a list of 200 in this group in about an hour. And this is what we start with. So there's a group, so you can come up with many, many financial statement ratios, and then you can group them into different groups. So the typical groups that we start with are leverage, which would be basically total liabilities divided by total assets, or it could be total debt divided by total assets minus intangibles. Then we also have profitability, which would be things like EBITDA over assets, or net income over assets, or net income over equity. We could all discuss that. Then there's debt coverage, and you can use EBITDA divided by interest expense, EBITDA divided by interest expense plus the current portion of long-term debt, operating cash flow, and so forth. The list gets long very quickly. A variable that's not that common is a growth variable. So we have variables that are designed to capture the stability of the firm's operations. One of the key ones that you see in all our models is sales growth. And what you find is that all else equal, rapidly growing firms are more likely to default, as well as rapidly declining firms. So slow growth minimizes default risk, holding constant for everything else. Then there's activity and liquidity and so forth, as well as a size variable. Okay. So activity is something like inventories divided by sales. Liquidity is cash divided by total assets, or current ratio. Then the way that risk calc works in terms of actually including the financial statement ratios into the model is we do what we call mini-modeling, which is we transform the data so that we build a single variable default prediction model through a non-parametric technique called LOS. And the way that I will describe it is if you think about it, you have your data, so you have return on assets here, you have a default flag here, and you have 10,000 rows. You could bin them so that you put 2% of the data in one bin, and you can order them by return on assets, then bin them. So you get a bin with 2% of the data, which is your most profitable firms, and then you get the bottom bin is 2% of the data with your least profitable firms, and then you look at the actual default rates for each of the bins, where you have 2% of your data. And then you get, that's what these dots represent for one of our models. So out here, the very safest firm has approximately the same default risk as the 50th percentile, or it's a diminishing relationship, whereas the least profitable has a much higher default probability. So it's a diminishing relationship that relates profitability to probability of default. And just briefly, the reason why it's called LOS is LOS stands for local error sum of squared residuals, which is a local regression method. And the way I think about it is you take each of the points in your data, you run a regression for that point, weighting the observations closest to that point the most high, giving the most weight to the observations closest to that point. And if you do that, you get a family of lines, which are the local regressions. And when you splice them together, you end up with a smooth curve that well describes the data. And then the only functional form that's imposing on it is that it's continuous. So that's why it's called a non-parametric method. There are many other techniques you can use. This is one that we find works well for us. Then we combine all the ratios into one probability default measure using a probit regression. And this is a graphical depiction of up there of the equation. So each of the ratios enters into the model in a transform space, and then you use that variable as your independent variable to predict default. And then we also have industry controls, and that becomes the model. That's the core of the financial statement only version of the model. It's the model that extracts all the information from the financial statements to predict default, or as much as is possible. And it's called a generalized additive model, or it's a particular application of the class of generalized additive models. And we see this functional form as balancing the need to be able to incorporate nonlinearities into the model to get a lot of predictive power, but at the same time, it allows you to separate out all the impacts of all the individual ratios on their own. So you can look at the impact of return on assets in isolation from everything else in the model on the probability of default. So it helps with transparency. then there's another layer of the model. These are the typical ratios that you find in our models across countries. So this is the UK, this is Japan, this is the US. And there's a good deal of commonality, like sales growth is in every model, but there's also differences across the models. So, and they do reflect the local accounting practices, like trade creditors divided by turnover is English for what we would call accounts receivable divided by sales. Okay, so that's in the model because that's how you would, that's the line items that you would look for in English, in UK accounting. There are also some variables, like change in accounts receivable over sales, that do look for things that you might call accounting anomalies. So if accounts receivable over sales is going up from 1 year, that says that your accounts receivables are going up in a way that are not explained by sales. We do find that that is associated with higher rates of default. It doesn't have a huge weight, but it is in a number of our models. And the converse of that is if your accounts receivable are going down in a way that's not accounted for by declines in sales, we do find that that increases default. And the thinking being that if your accounts receivable are going up, that means you're not collecting. And if your accounts receivable are going down, that means you've written something off, which could be harbingers of things to come. There are those types of things in the models. And then there's the credit cycle. This is one of the challenging aspects of the model. Okay. And one of the questions I commonly get is like, is it a point-in-time system or is it a through-the-cycle system? And I'm not going to comment on that. But you do see throughout the world a tendency, and it doesn't happen every time, but when there is a recession, you do tend to see defaults go up or bankruptcies go up. And then when you look at financial statement information, to the extent that the price of oil were to double tomorrow, and we were to go into a recession, if that were to trigger a recession, particularly for private firms, there's a time lag associated with when you would end up in, when that would show up in the financial statements. Okay, so tomorrow is April. You'd see some of it in the year-end financial statements that the bank would get about this time next year, but you wouldn't see that much because it would take time for it to hit the financial statements. Okay. So the way we handle that is we use the Moody's KMV public firm model, which is our model, to come up with an estimate of what's happening to the macroeconomy as measured by public firms in comparable industries, and if their risk is trending up, we adjust up the risk that comes out of the financial statement only view of the model. And that, you end up with this type of picture where this is the median EDF coming out of the model for the US from 93 to 2006. And the red line is if you only look at the financial statement information. And if you only look at the financial statement information, it's peaking at about 2003, which is when the market was actually turning. It's a lagging indicator. But by incorporating an element from the structural model from the KMV approach, you actually get a leading indicator. It's showing that the default risk in the US economy actually went up about in 1999 and stayed up throughout the dot-com crisis. And since it's come down, so the day that we're in a very benign stage of the credit cycle, volatility is very low and leverage is low. And that's what we see. Okay. So to get back to the example of the CDO market, one of the most challenging things of actually getting a credible probability of default model, whether it's public or private, is saying that the EDF is actually correct. Okay. You can evaluate a model on basis of whether or not it does a good job of rank ordering credits, saying this company is riskier than that company. And if you're running a long short book, that may be all you need. But you can also, and the common tool for doing that is variations upon what we call cumulative accuracy profile, accuracy ratio. But what we see as harder and more involved is to say that, well, if the model says the expected default frequency is actually 2%, do you expect to actually get 2 defaults out of 100? Can you actually justify that number? And that is problematic because default events are rare, and default events also tend to be clustered. So what will happen is if the model is working well, most of the time you'll overpredict defaults. Defaults will be lower than what you predicted, but in a particularly bad year, you should get it wrong. it will underpredict defaults, so that on average you're getting it right. Okay? And you'll need a lot of data to show that the model's actually doing that. That's one component of the problem. The other component of the problem is that, particularly for private firms, the data is not that reliable. Okay? So the way we built these first models is we went to banks and we said, give us all your financial statements. And they gave us all their financial statements. And I think the reason why they had the financial statements for the people of you from South Bend is that Pro-Chiswick had been creating them. We had been collecting them. So they knew how to get their financial statements out of MFA, which was a Pro-Chiswick product that we actually bought for the people from South Bend. But they didn't have the default dates. So when you asked for the default dates, they said, well, they would give us whatever they could come up with, and they tended to have a historical bias, so they knew who defaulted last year, but they didn't know who defaulted 5 years ago. And they also didn't, at the time, they couldn't even tell you if the financial statement that you saw in 1993 had a loan outstanding with it. Because it may have been a financial statement that they entered into the system before they gave the loan, on a historical basis, before they gave the loan. So there is a sense that when you build a model and you actually look at how many defaults you have in your sample, that you were undercounting defaults. And the way that we dealt with that in 2000, and in many parts of the world even today, is we make a judgment as to what the average default rate for this population should be by looking at a variety of sources of information, such as bankruptcy rates, loan loss provisions, and so forth. And we came up with an estimate of, well, it should be 1.7. That's a reasonable triangulation of different numbers. Since 2000, what we have been doing is collecting actual loan accounting system data from 5 different banks in the US. And what you can do with actual loan accounting system data is you can see when the actual loan, not the customer, but the loan, goes into a status that is 90 days past due, substandard, non-accrual, or charge-off, which are typically the 4 types of defaults that you see in a bank accounting system. And when you work with that data, you can come up with an actual default rate for the population according to the specific definition you use that allows you to evaluate the risk of the firm. Okay? Which means that in 2006 today, we can actually see how well did the model do from a level validation perspective. When we said it was 1.7, did we get it right? And the answer, since I'm telling you about it, is that we were pretty pleased with how it did. So default rates in 2000 were 2.7. That would be an adverse stage of the credit cycle. If you look at what the model predicts, a default model doesn't predict that there will be 2 defaults out of 100. It predicts that there will be a distribution of defaults. And that distribution has a median, a mean, a 10th percentile, and a 90th percentile. And I can go into how we actually compute that distribution if you're interested. But the 10th percentile was actually below 1%, and the 90th percentile was as high as 5%. And what we saw is it was in between the median and the mean. And then it was trending downward as the economy recovered to a low of 1.1%. So in a sense, this shouldn't be surprising after the fact, because this is what allows the rule of 3-3-3 to work, that in order for your net interest margin of 3 to be profitable, you need losses to be lower than 3%. So if your losses had turned out to be, if your default rate was 6% and your recovery was 50%, then you would have lost money, you have fees, you have people to pay, and so forth. So a default rate of that's ranging from a high of 2.7 during a particularly bad stage of the credit cycle to a low of 1.1 during a particularly good stage of the credit cycle makes sense. But this was kind of for the first time we could see this information. And to conclude. Yes? Okay, the way to So suppose so we have a sample of firms, right? And we have a PD for for every firm in the sample, then we observe whether or not they did default. So let me take that more complicated problem and simplify it. So suppose you have 1,000 firms that you say has a probability of default of 10%. That means some of the time, 1%. That means some of the time you're going to see less than 1%, some of the time you're going to see more than 1%. Even if default events were non-correlated, that distribution would be skewed. And you could compute that distribution and plot that distribution, and then see how the model performed relative to that distribution. But then when you take into account correlation, the distribution actually spreads out. Okay? And that's where you get the 0.9% to the 5.2%. Okay, that's using a correlation number of 0.2, which is what people think it should be. It's very hard to measure it with 5 years of data. And that correlation of 0.2 does mean something to people that manage portfolios and people who price CDOs. Okay? It's the correlation coefficient in a Gaussian coplot, if you will. If you used a smaller number, they would come together. But what this says here is that the actual default rate was between the median and the average, or the mean, that the model would predict using like a portfolio type model. So that's good. Whereas here in 2005, the actual default rate was above both the mean and the median, but was below the 90th percentile. Okay, so that says the model somewhat underpredicted defaults, which could be an issue. But at the same time, it's within the range of the sampling variability you would expect. That's the way to interpret it, or the way we interpret it. So to conclude, in this emerging market, which we call the middle market for debt, financial statement ratio analysis that's embedded in these models is playing a key role to create a market so that people can trade these types of debt. And they're not trading so much on their own, or at least that's my sense. When they become big enough to become a syndicated loan, then they start to trade as an individual loan. But they're trading through these securitization packages that are packaged up into a CLO. Using loan accounting system, we see that the actual default rate is within the realm of what we've been using to predict the default rate in this market. There's been a certain conservatism built into how these deals have been rated. So going through time, you are starting to see what's called a specialty finance firm, which is firms that go out and look to loan money to small to medium-sized enterprises and package them up into the deal, competing for loans. And if you're an economist and you believe in more information and more liquidity, that should, in general, competition benefit the consumer, which in this case would be the actual borrower, the entrepreneur. And you might think that that would reduce spreads. You would actually see spreads go down. Okay. Thank you.